Hey Rent Retires, it's Adam Schroeder here, and today we're going to talk about, is a break-even cash flow a good real estate strategy? Alright, before we get started, I wanted to remind everybody, please subscribe to our YouTube channel, click the notifications bell, don't miss out on any of these videos we're putting out. We're trying to make you the best possible investor, and the best way to do that is to watch the stuff we're putting out and just become more and more educated. At the end of the video, if you found it useful, please like it, let other people know, let the algorithm know that people should be watching this if they're interested in learning about real estate. And as always, if you have any questions about the video, or if there's any topic you want us to cover, enter that in the comments below and we will get back to it as soon as possible. So today we're going to talk about 4 pros, 4 cons, and 1 recommendation to having a break-even cash flow strategy in real estate. Let's start with the cons. Number 1 is the most obvious con there is. You're not making any money from the property. Now, obviously, when people go into real estate, what are they trying to do? They're trying to create passive income from their property. So they're wanting cash flow from that property. But that's not the only way you can get a return from real estate investing. But the number 1 problem is you're not getting the monthly cash flow that you're expecting, that you're hoping for out of your rental property. So that is obviously the number 1 con of this strategy. The second downside is that because you're not making any money monthly from this property, any expenses that you have, any repairs, any vacancy is going to hurt you. That's going to be, expenses are one thing, that's going to be, anything that comes up $200-$300, boom. That's not just a month of cash flow. That's an infinite number of months cash flow initially, whenever you're looking at it. So that is the second con of the deal, is that you could end up losing even more money as your vacancy, as your maintenance hits. The third con is that it lowers your return. Obviously, if you look, all of these cons are based on the fact that you're not making any money on the property. So it's going to lower your returns dramatically. Obviously, the cash on cash is going to be 0 because you're getting no cash on all of the money that you've invested in the property. You're still going to make some money whenever you look at the fact you're paying down your mortgage and your principal there. You're looking at, if any appreciation that's happening, you're getting money there. But overall, your return is going to be decently lower because you aren't actually making any cash in the deal. And the number 4 con to it is that it can be harder sometimes to make the numbers work for the lender. We've talked about the debt service coverage ratio. We've talked about the debt yield before. Well, if your property's coming up with a flat cash flow, it can sometimes mean that you have to put a little bit more money into the deal to make your debt service coverage ratio good enough for your lender to want to loan you the money. That's not every time. Don't take it that way. It is not every time, but sometimes it can be a little harder to make the numbers work. So why on earth would you do it, right? What's the upside to this? Well, let's talk about 4 big upsides to it. The number 1 reason that we're going to talk about today, the first one, is that you're still getting all of the tax benefits of real estate. You're still getting to write off a lot of your mortgage insurance. You're still getting depreciation from the property. So even though it's not putting money in your pocket monthly, you're still getting a yearly benefit from your taxes. Remember, the government doesn't care if you are making money on your investment. It just cares that you have the property, and it tells you the tax rules that you have to abide by or that you can take. Remember, depreciation happens whether you take it on your taxes or not. So you may as well take it on your property. If you don't take depreciation for 10 years and then you sell it, well, guess what? They're going to act as if you were taking it the entire time. The second good side of this is that losses that you take from this one property can be used against rents that you've gotten from other properties and to lower your taxable income. So just because you're losing money from this one property doesn't necessarily mean that your overall portfolio is going to be hampered. Now, obviously, you're not in real estate investing to lose money, but if all of your properties are cash flowing well and you have one that's just break even, say you decided to make a big appreciation play and it's breaking even, well, losses that happen there can help you tax-wise with your other properties. The third thing that's a pro about this is oftentimes, not always, but oftentimes the reason a property is break-even cash flow is because you are leveraged in that property close to 100%. If you're able to get a 100% finance deal that breaks even, you are in a fantastic situation, because this is allowing you to space your money out more and get more properties. Now, obviously, we want these properties to be safe and secure. We want you to be able to pay the mortgages for them so that you're not looking at some foreclosure issue, in the future and having to do short sales or, get out and be underwater on a bunch of these properties. But it does usually mean that you're leveraged significantly. And as long as you've assessed your risk and decided it's worth it, it can be a great way to get multiple properties quickly in this day and age. Also, the final one I want to talk about today is, remember, the break-even cash flow that we're talking about is year one. Your rents are not going to stay flat, especially in today's environment. In today's environment, we're seeing national year-over-year increases in rent of almost 10%, over 10% in some places. And in the markets that make the most sense for investors, you're looking at 10 to 15, sometimes 20% rent increases year over year. So your year one cash flow may kind of be bad, but year two, suddenly you're making $200, $300 a month on that, and you're in the appreciating neighborhood that came with it. So just remember, you look at the numbers when you buy, but you need to not just focus on year one. We're looking at the long-term picture. In 10 years, your rent could be $800, $900 more than it is today. You just need to look at it over the long haul. So what's the recommendation for this? When would you do this? I would tell you that the number one reason, the number one investment that you can make for a break-even cash flow property is a new construction property. Why is that? Because number one, it's probably going to be in a nicer, better appreciating neighborhood than you would get otherwise. So you're able to get in and get a break-even cash flow in an A minus, maybe a B plus neighborhood, as opposed to taking a higher cash flow from a C minus neighborhood or maybe a C neighborhood. So you're looking at better quality tenants, a better quality product, because even in rehabbed, fully turnkey properties, you're still dealing with the base that's 80, 90, 100 years old in some cases. So you just have a stronger foundation. But then you also have the higher appreciation possibilities with these neighborhoods being nicer. And because of that, because it's newer and you have less maintenance, you're less likely to experience the downside of all four cons that we talked about, where you're just not making any money. So you're in a situation where you're looking at a good appreciation play with solid rents and a solid chance of good rental increases with the new construction property. So I hope that's been helpful for you. Break-even cash flow can be a good real estate investing strategy. I wouldn't recommend it for every single property you have, obviously, because we're in this to make money. You want to be getting money all of the time from your properties, so you don't want to just have 50 properties that make you $0 for a while, but it's worth looking into and potentially adding into your portfolio. So I hope that's been helpful. Please click the like button if you've liked this video. If you think it'd be of any use to any investors send them the link. Leave a comment below if you have any questions about the video or if there's anything you'd like for us to cover. Also, check us out at renttoretirement.com. That's renttoretirement.com. You can see the properties we have there. You can get in touch with some of our investment strategists to help you figure out what you need in your real estate portfolio, what team members you need in your real estate, business. We're here to help you. We're here to educate you. So please reach out to us through renttoretirement.com. You can also listen to our podcast that's coming out twice a week, where we're bringing in experts and talking about the markets that we're in, the real estate market in general. We're trying our best to help you become the best real estate investor you can be. So that's renttoretirement.com. Don't forget to subscribe to our channel and click the notifications bell, and we'll see you on the next video.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.